In this week's update, market change character in the last month. Is it temporary or a more meaningful trend change? And we're still await for earnings season. My name's Gary Davis. I'm an authorised representative of Primary Securities, and the information in this video is of a general nature only. All right, let's have a look at semiconductors, because that's been the flavour of the headlines for the last couple of weeks. And there's a lot of commentary around whether buying the dip in semiconductors is a good thing to do or not. It's really hard to know if you've got an open mind. I mean, you can get sucked into the story and the headlines and the wave of enthusiasm. And the fundamentals do look incredibly compelling, and that's what makes it fairly normal to respond in a very positive way and have a, yes, of course you should buy the dip kind of attitude. But fundamentals aren't really that much about timing, particularly over periods of weeks or perhaps even months. So you've got to be a little bit cautious in just going, of course, buying the dip is the good thing to do. Because markets price on forward expectations, and semiconductors have run a long, long way. Now, make no mistake, I'm not making any prediction on semiconductors. I think over the longer term, they look compelling, no question. But could there be a sharp correction in semiconductors because they are so stretched? Yes, they might still present obvious value, like Micron, for instance, still trading on a forward PE multiple of something like 9. But markets are looking forward and taking into account many other factors other than what most investors are looking at right at the minute. So from my perspective, the probabilities have lessened. That's a fact, and I'll show you that in a minute why I say that. So there's no question that the probabilities have lessened, but does that mean that the prices have to fall? No, of course not. They can just turn around and go up and set even higher highs. And that might seem unreasonable to some people, but it just is. And you've got to abide by that, particularly if you're a shorter term trader. So just blindly buying the dip, it might work. But lower entries are now more likely. Or if you're in the stock, you've got maybe a bit of short-term painful downside that may or may not work for you. So that's where you've got to think about the market in terms of probabilities and not just the longer term and ignore the short term. So in a short-term trade, semiconductors have become more of a guess or a hope trade. So let's go and look at the semiconductor index and see why it is that I say that. So the fact is, if you look at this last 6 weeks, since we've started going sideways, since the start of June, you've got to say that chart pattern, in other words, money flows, the balance between buyers and sellers, that is different to this or to that, which was quite narrow, went sideways, but it was very narrow. Now we've become a lot more volatile. So that's a fact. The character of money flows has changed in the last 6 weeks, and it's changed in multiple ways. The length of the candles, where they're closing, the gaps, the volumes. We've got more big volumes on the downside. So there's no question. So by definition, the probabilities of semiconductors being higher in the next week, 2 weeks or month are lower. I don't know how much lower, but they're lower. And so that means there's higher risk. So then it comes back to clarity about how you're going to play it. And if you are participating in the market without being clear on what your purpose and your time frame is, then you're going to get kicked in the tail. You need to know whether you are happy to ride it out because you've got a 2-year view, say, on semiconductors. And I think with a 2-year view, you could feel pretty confident. Are you going to employ stops would be the second type of investor who's not that worried about really short-term downside, but certainly doesn't want to get stuck for 3 months with downside. Or are you the sort of investor that if your weighting is high, let's say more than 10%, and that would be very easy, if you've been in SMH for any period of time, you could have easily doubled your money So are you the kind of investor that intends on taking some partial profit when the market signals that the character has changed, which it is obviously signaling now? So it gets back to the question, have you got exit rules to guide your actions, or are you just making it up as you go along? What kind of feels right, or you might tune into some social media and kind of test the general consensus opinion. And remembering that general consensus opinion will always be wrong at the extremes. The situation that could change this, and I'm as bullish as anybody over the longer term for semiconductors. So don't make any mistake about that. I'm just talking about what might happen in the next couple of weeks, the next couple of months. What happens if the Fed hikes rates and the Fed chair comes out with a hawkish outlook to the end of the year? In other words, points to the probability of more rate hikes. What happens to semiconductors under that condition? And the answer again is, I don't know, but it's not helpful. May or may not stop the trend, but it's certainly not helpful. So that is the way that you've got to think about semiconductors. It's not a green light, red light situation. I'm either in or I'm out. It's what is your weighting? How do you rebalance to still retain exposure to the upside, but protect the downside to a level that you're comfortable with? That's really the question. And this just gets to the essence of really successful investing, that you're open-minded, you think in terms of probabilities, and you rebalance your portfolio as required. So continuing on with this slide, so it's positioning that's important. That's all we've got as investors. We have no certainties, no guarantees. It's just positioning according to an open-minded assessment of the odds. That's all we've got. Whereas most investors, they want certainty. That's just a natural human trait. So we've got this clash between investors' subconscious or conscious need for certainty. Tell me how this is going to play out. I need to know. Well, you can't, and you actually don't, because you're in control of most things. So this need for certainty and drawing a line between logic to predict. If something is logical, like demand for semiconductors is just fantastic. They've hiked their prices by 40% quarter on quarter. It's just so logical that they've got to go up. But as a timing tool, it's nuts. It doesn't work. It doesn't work often enough to hang your hat on. So fundamentals, using them for current pricing is just misleading because the market is pricing the future. It's not pricing the current. And that is the biggest thing that investors need to understand. Looking at the technicals with respect to semiconductors, will it be just a V-shaped mini correction down and back? Or could it be an ABC correction? And I'll come back and explain that a little bit more when I go back to the slide. Or could it be something more meaningful, something that is more of a Fed income correction, which would be a 5-wave correction to the downside? Not that I'm a devotee of that sort of analysis, but it does have some validity. So I think I've already covered that. So let's go just back quickly and look at that chart again. So a V-shaped correction seems to be off the table for now. This pattern is just, it's too deep, it's too erratic. We don't have a V-shaped correction. Is it an ABC correction? So there's the A leg to there, B leg up, C leg down. So is it now done? Maybe. But because of this erratic volatility, I now want confirmation. Confirmation that this is the bottom through here, around about 570 on SMH. And we don't have that. We've got some gaps. We've got wicks, or small candles, wicks on either end. There's no conviction there. So what is my response to that? Well, my response is to lower my weighting and wait and see what happens. Be guided by the market money flows. And if you consistently do it that way, then you'll do far better than any other emotionally based approach to the market. Absolutely no question. All right, every week I talk about this because this is important, and in the last few years has just become even more important that you've just got to be so clear about what you're doing in the market that you need to consider all the things that could go wrong, all the things that you need before you take any action. Jumping into the market because you think it's an appropriate place to make a bit of cash, you might as well go to the casino. Your odds probably aren't a whole lot different. American stocks, S&P up 1.2, the Nasdaq up by 1.7, so a positive week in the end. But small caps went down a little bit, 0.5% on the Russell. And then we had the SK Hynix from Korea, which is one of the three big memory makers of the world, SK Hynix, Samsung and Micron. And it listed a $26 billion capital raising on the NYSE. It was successful, I guess is the conclusion, because it rose 13%. And when you've got these massive IPOs, you've got leveraged ETFs, it might all be fine. But for me, the dynamics of the market are getting stretched. And the fact that Micron trades on a PE of 10 is not going to hold the market up if the dynamics change for the worst, because the dynamics are not tied to the fundamentals, and that's what you've got to understand. Overall in the market, it's pretty clear that we've got rotation and not desertion from the market. That's the good news. And there are multiple reasons to conclude that, but one of them is the VIX. And the VIX is at 15. So I'll just zip down to there. So the VIX is down at 15. That is not a market that is being deserted by anybody. So we're rotating. So there are other sectors, and I've got a slide on this in a minute, that are outperforming technology or semiconductors, whichever part of tech you want to look at. And so some consideration to rebalancing, in other words, taking some of your weighting out of technology and putting it into industrials or healthcare is not a bad thing to do, because technology and semiconductors are really crowded trades. Now, what does a crowded trade tell you? It tells you that an awful lot of investors are already in. So where are the buyers, percentage-wise, to keep that index going higher? There's a lot less of them, and there may even be exhaustion. And that's why crowded trades have always got a timestamp on them. Now, the US dollar, 101, basically, and it retested the breakout, as we'll see. The 10-year yield edged up from 4.48 to 4.56 at the end of the week. So I said last week we'd be watching bonds. Bonds are still moving high, and that is not great for long duration assets like technology or even for healthcare, for instance. So let's go and look at some of the important charts. We'll start with the Nasdaq Composite on a daily chart. And you can see we're a bit of a ways off the peak, and actually further off the peak than the S&P is, even though the relative performance of the two are similar. Next, we've got, this is the sector breakup of the US market. And over the last month, so that's the date range on the last months, industrials are up 7.5%. Industrials is a very broad sector, a lot of different kinds of stocks in there, but that is the outperforming sector index, followed by finance at 7%, and then healthcare at 5.7%, and technology came in at 5.3%. So if you're more of a trader or you're a shorter-term investor, then if you took each of the top sector groups and look for the top groups within each sector, and then looked at what are the best either continuation patterns, so stocks that are already rising with great momentum, that are not showing any signs at all of rolling over, or what are the best reversals or rebounds that are shaping up, then having money, some of your money in that, and not a huge amount of your money in crowded trades, is just really sensible risk management. It's just a good way to go. While we're here, let's look at the Australian market over the last quarter. So information technology had rebounded. Then we've got the ASX 200, and below that is everything else. So XIJ was the only one that outperformed the index, and everything else seriously struggling. And that's been the story of the ASX 200 all year. Turning now to the S&P, so you can see where it's a very similar pattern to the NASDAQ, but it's closer to its all-time highs. Now, that's because it wasn't as robust in setting those all-time highs in early June. And then the Russell, we're down a little bit on the Russell. XLE, we've got a kind of a partial weekly rebound, but did come down on Friday when the initial fright of the war in the Middle East restarting in some form or other popped its head up again. So that's the US market. Turning to Australian stocks, just under 70 is where we finished on the Australian dollar. Our index was down 0.4% for the week. Materials were lower, but rebounded very nicely off the 200-day. I'll show you that. Banks made it 5 weeks in a row of either even performance or making a gain. And energy bounced off the 200-day moving average as well. And there's one other stock that I want to show you, and that is SpaceX. And it's related to what has just happened with SK Hynix, and therefore with the whole semiconductor sector, because SK Hynix is $1 trillion company, so therefore has a significant bearing on where SMH goes. This is SpaceX. So it launched with incredible fanfare, and I said at the time, don't touch it because you'll probably get a better entry. And possibly that better entry might even take until 12 months after listing. And it's fallen. It's fallen quite a bit from up above 200, and we closed the week at 145. So it's down more than 25%. So I don't know what's going to happen with SpaceX from here. Is it going to drop to 100 or go up to 200? No idea. But that's exactly the point, and that's the same point with SMH. I don't know what is going to happen because we've got a change in character. To what? I don't really think about because I'm guided by the market. And that's exactly the point about managing weightings. And it shakes the life out of me when I hear about some investors that have got 50 or 60% of their money in one stock or one sector. It's just the way to go, that's for sure. So turning now to the ASX 200 on a weekly chart, very little change. There's materials on a weekly, but let's just pop that on a daily. You can see there's a pretty nice bounce off the 200-day. Will that repeat? Well, we need to see a bit more evidence of that. A long-range candle like this one shows emphatic support. So that's what we need to see. If we look at information technology, not a lot happening there. That's on a weekly chart. Healthcare, we have had a really nice 4 or 5 week breakdown, but we're still below the 20-week moving average, or we're just borderline on it. This could easily come back down and carve out some sort of W pattern. Finance, the only thing really that positive, it's held up well. Don't understand it. The constituents are all overvalued from my perspective, so I'd rather just leave it alone. And the same with energy. Energy, we've had a bounce as well. We're oversold on a weekly. We've bounced off the 200-day moving average. So it's an opportunity for traders. But because energy policy in Australia is such a mess, I'd rather just let the sector go and put my focus on higher probability pursuits. All right, turning now to the precious metals sector, that's silver. So I'll go to the slide first. So gold was down 1.2% for the week, still hanging around this 4,100 level. In Australian dollars, we just dipped under 6,000. Silver finished just under 60 with a little bit of a rebound. And what's happening here is what happens all the time, and particularly after a period of excess, which we saw in 2025 when everybody just got so terribly bullish on the gold sector. It's shaking out the weak hands. And it does that in a more amplified way than any other sector that I know. It's just really good at doing it. And it crushes the aspirations of people that really are just been joining the crowd. So that's the process that's going on, and it always tends to go longer and deeper than what you think because you've come out of a euphoric kind of environment, and that's why it seems to take a lot longer. But look, I can say this, that we are far, far closer to the bottom than the top. What is not clear is the time frame before this wretched thing starts going up again. We don't know, and so it's been such a sharp shakeout that we need confirmation. You don't want to be guessing in the precious metals market. But the first comment is correct. We're far closer to the bottom than the top. Now, if we look at gold stocks in the US, GDX and GDXJ are also changing character, whereas GDX listed on the ASX, which tracks the same index as GDX listed in New York, but it's still in freefall. And a lot of that is because of the currency effect, and I'm talking about the stocks there. And I showed this last week. What do we need to see for the major up leg to continue? We need to see the ratio between gold and SPX. I've been talking about this for months now. We need to see that ratio turn up, but at the moment, it's still not. Gold is underperforming the S&P 500. And until that flips over, then you don't have a sustainable rebound in gold stocks. So let's go and look at some of those charts. So we'll start with silver. This is on a daily. We seem to be forming a base. It's not definitive yet, but it's a start. We've started going sideways rather than forming lower lows. So that's a useful start. Let's look at gold. The economic reality around gold, if you want to put your fundamental logical hat on, is that they've got $1 trillion deficits. They've got total debt of $40 trillion or some such number. We've got rising yields because of inflation, and rising yields are not good for gold or they're not perceived as good for gold because gold doesn't have a yield. We've got interest rates with a hiking bias. I mean, you would have to accept that that's a fact. We've got US supremacy being challenged in so many different ways, whether it's trade, geopolitical power, military power, whatever it might be. So that creates a huge amount of uncertainty, and it plays out in the financial markets. Central banks are buying gold at record levels over the last 3 or 4 years. So that's a positive. We've got so many factors that are continuing in a bad direction for the US economy and therefore should be good for gold. But it doesn't seem to be working. So what we've seen is a massive shift over the last couple of decades. We've got wars and extreme geopolitical events used to boost gold. It was the fear trade. War would start up and gold would rocket off because people wanted to be away from currencies. But now that doesn't happen. Now it impacts oil. Price of oil goes up. And because the US dollar goes up and inflationary tendencies go up, it depresses gold. So over the last 2 decades, there has been a huge shift in the way that the market responds to things that used to propel gold to the upside. And that's what a lot of people are struggling with. But having said all that, on a big picture view, this is the most potent contrarian setup in the last 50 years. And I've been in the market almost 40, so I can remember most of it. And the potential reward for risk is as attractively compelling as I can ever recall. And that's what's so frustrating about that market not playing ball with us. The upside potential to the downside, the ratio between those two things is massively compelling. And the question remains, it's almost a given that things will change, but the question is when? The likely trigger is the trajectory of rate hikes, or that's not quite correct. It's the perception about the trajectory of rate hikes. And that's the difficulty because perceptions are constantly evolving. So when you look at the character of the trend, the downward momentum in gold is slowing. You look at this bit here, and you compare it with this or this any other time since March. And it's different. It's changed. There's no argument about that. So it's slowing. So that means that at this point in time, given everything that we know, that the sellers are starting to be satisfied. We're now coming into balance between buyers and sellers. So the downward conviction is being lost, but there's no upward momentum yet. And who knows, this could continue for 6 months. So you don't want to start to go jumping in yet. You need confirmation after such a decline. And one of the key things to watch is this ratio, gold to S&P, and it hasn't changed. We had a little blip last week, or the week before, I beg your pardon, reported on it last Sunday. But we've turned over again. So still nothing doing in that sector. So there we go with precious metals. Now, what have we got coming up that could change things? Well, we've got dual earnings season, and we know that so many producers are just making free cash flow just hand over fist. And at some point, the market has to take account of that. And it'll stop worrying about other things like a rising US dollar or inflation or whatever, and it will just start to price something different in. And stocks will normally lead that reversal. So that's the thing to watch out for. Other commodities, copper, $6.23, no change there. Crude oil, 71.5 after the bounce. And I read this morning, and I don't know how many times this changed while I was asleep, that apparently the straits are now closed again. So all too hard for me. I said last week, was this a contrarian setup? Look, maybe we are at long-term support. We are grossly oversold. We might get a short-term bounce, but what are the probabilities around that being sustained? Not very good from my perspective. There's the copper chart. So we got down to 6. We've bounced to 625. Here's the crude oil chart. Little bounce, couple of long wicks, and then we're heading down again. Wrapping it up. If you only think in terms of, am I winning or am I losing, then you're in a lot of trouble and you completely miss the point about what makes successful investors, and your results will be far worse. And I do hope that everybody who does tend to think in terms of winning or losing outcomes on an individual stock basis really takes note of that, because it'll change your investing life if you start to think differently. If you think that way, your decisions will be based on emotions, either conscious or subconscious. You know, a lot of people don't even realize they're doing it. This is a time for being a bit conservative, for being prudent, having some cash, because there's a rotation going on. I'm sure you'll find far better reward for risk in some other sectors, like industrial, finance, or healthcare. Now, we could just be in a continuation situation. Go back to that chart on SMH. For 6 weeks, it's been going sideways. It's been very volatile. It's really changed character. But it could just be a broad horizontal correction for 3 months, maybe longer. And then it'll just get back on the horse and it'll start going up again. I don't know, and I don't really care. I'm just rebalancing my portfolio, adjusting my positions according to it. Or other sectors, such as industrials, finance or healthcare, could be at an inflection point where a much better reward for risk is available. But you don't want to be making major adjustments. If you're really heavy in tech and memory stocks, then you don't want to make huge adjustments until things are a bit clearer. Do it gradually. Rebalances don't have to be a dramatic event. You just do it progressively, bit by bit. And this is what I said last week. I thought it was still a buy the dip environment, but the dips that you want to buy should be deeper. And if you don't get deeper, then don't play, because you need deeper to justify the higher risks. And the final thing is just forget about the headlines. If you get drawn in by headlines and expect the market to respond to a headline, it's too late. It was priced in before the event. So that's it for me. There's more information on the website, and there's my email address, and I'll be back with you next Sunday. Cheers.